We're fresh off a tough year-over-year number and a month-over-month number in CPI. It's bigger than expected. The Fed responded last week by raising rates 75 basis points and sounding a lot more hawkish. Almost 16 hikes, 16, hard to believe, are priced in for 2023. We've already had 6. Can you talk about expectations for future inflation and what's driving it, particularly around food and energy?
We've certainly seen a couple of things that have been shifting more recently. And the Fed sort of indicated their concerns about the longer term inflation expectations potentially becoming unhinged. And, when you start to look at a lot of what's driving those inflation expectations, one of the things that the Fed likes to look at are the Michigan surveys, right? And so you can see on this first chart here, we've got both the 1-year and the 5 to 10-year inflation expectations from that University of Michigan survey outlined. And what are we seeing? Well, you can see those shorter term inflation expectations really being driven almost exclusively in lockstep with energy and food prices. So, it's certainly when you look at how we're thinking about things, the biggest impact to those really expectations are coming at what your grocery bill looks like and what you're paying at the pump. But what's interesting, if we sort of look past that, I think you have a little bit of a differentiated backdrop in terms of some of the things that the Fed is focusing on. And really, we've heard that the last comments from Powell during that last meeting, they're really focusing a little bit more on this New York Fed survey that I've got pulled up here. And you can see if that 1 year, again, pushing higher. And as we just spoke about, a lot of the focus there is going to be on that short-term gasoline and food price backdrop. But longer term, 3 years out, it's still fairly well range bound. And when you start to think about that, as long as those inflation expectations remain fairly well anchored, and yeah, they've shifted a little bit higher. You can see the longer term trend has been at 3%. It's drifted up towards 4%. But really, since the start of 2021, it's been holding right around those levels despite gasoline and food prices marching higher. And I think that's the key in here, because as the Fed is able to sort of look at those long-term inflation expectations and they're remaining fairly well anchored, that gives them a little bit more room, a little bit more time to operate. And so I think that's a key factor in terms of how the Fed is looking at things going forward. And it's going to persist that they're looking like they're behind the curve. That's part of the shift that they've talked about in terms of letting the inflation data come to them rather than relying on their forecasts. And they've been talking about this for quite some time. It's going to stay like that. But as long as these longer term expectations remain fairly well anchored, that's a good sign. And what we're also seeing, and this is also coming out of the Michigan survey, you're seeing a little bit of the expectations in terms of how they're looking into and sort of how they're expecting this to evolve is very important. And you can see here the percentage of respondents that are expecting gasoline prices to increase has actually been dropping, and the percentage saying that they expect them over the next 5 years to decrease on the rise. And that's very important, because as we talk about that factoring into the inflation expectation backdrop, if people were actually expecting these inflation levels to be picking up, they probably would start pulling forward some of that consumption, right? If you know prices are going to be rising, you're probably going to want to get in front of that spending or those price hikes and spend today. And the fact that we're actually seeing expectations of inflation pushing forward and gasoline prices dropping over time, that's also part of that longer term phenomenon here, where they're actually anchoring those inflation expectations.
I think the interesting point, catching on to the tail end of this last slide here, is that you haven't really seen the conditions for any sort of inflationary spiral playing out here. You're not seeing that type of hoarding. Now, obviously, consumers can't really hoard gasoline, but you're seeing that in a lot of the survey data for a lot of other goods as well. So consumers know that prices are high. They know that it's a poor time to be making some of these purchases as a result, but they actually do expect them to come down over time. And that's an important component that feeds into the expectations channel and to ultimately realize inflation moving forward. But if we jump ahead, I think what's really interesting on this next slide is we talk all about inflation expectations and elevated inflation in the future. But when you look at the empirical data, it really doesn't support that thesis. And I think it's really interesting. There was a recent Fed paper, high profile one last year, which kind of pushed back against that long held belief. And if you just simply take a look at this slide here, you'll look at, again, that University of Michigan expectations in the light blue. We've overlaid that with more of a professional forecaster and an economist look at expectations. And then in red, you'll see what the forward 10-year actual inflation was from that point forward. And the bottom line is, historically, you've seen that consumers as well as professional economists have consistently overshot in terms of what their expectations for inflation are relative to what that actual inflation was in the subsequent years here. So we talk a lot about the risk of expectations on anchoring, but when you start to consider the dynamics at play, one, drifting, expectations drifting higher doesn't necessarily translate to higher realized inflation. But more importantly, when we think about the Fed's reaction function, there's not really a whole lot of risk to those expectations unanchoring. We're not really seeing significant signs of that anytime soon. So yes, the Fed is watching that, and that's part of the reason why they went 75 at the most recent meeting. But a lot of those fears, I think, are a little bit overdone at this point. And so when you translate that to the policy backdrop here, I think what's really important is that the Fed has, obviously done a lot of the tightening so far through forward guidance, talking the market up, and the market's done a lot of the heavy lifting here. At this point, it really comes down to execution. Do we see the Fed actually following through on what's priced in relative to their own median dots, as well as to what's priced into markets here? And I think this last slide I'll show does a great job of highlighting that. You'll see here in the light yellow lines just simply the Fed funds rate, but you'll see going forward that purple or that dark gray line, that's the market's expectation, the SOFR curve, essentially forward rates pricing in where the Fed's moving. And we've overlaid that with the dot plot here. So you can see essentially market's fairly in line with the dot plot. But again, it comes down to expectations. And if we see a lot of these inflationary forces working themselves out over the next couple of months, that takes pressure off the Fed to move as aggressively. And it looks like we may have priced in too much of a tightening that we might not see pan out. And that certainly would be going a long ways to helping rebuild risk appetite within markets.
So we're going to move on here and talk a bit about the consumer. And Jack's going to take over here again and talk about that. It's, as I said, really important to the overall economy. 70% of GDP is the consumer. There's so many differing opinions, though, in my judgment, on kind of where the consumer is today and where their consumer health is overall. So can you talk about kind of the broad spectrum of the consumer, Jack, and how they may be impacted across that spectrum based on the rising prices that we've seen?
Yeah, and one of the big charts that I think you continue to see, we show a lot of the consumption baskets, if you will, the individual line items relative to the overall spending backdrop. So in a lot of cases, some of the charts that you'll see, it's gasoline and other spending relative to those total personal consumption expenditures. So basically, what's the wallet share, if you will, of gasoline spending, energy consumption, food? And just to give you somewhat of a snapshot, historically speaking, gas and other energy spending related items as a percentage of that wallet has roughly been over the last couple of years around 2.5%, 2.6%. So fairly small allocation of that total income, if you will. Put that into some context, if you go back to the 80s and 90s, that ran roughly 3 to 4%. And if you look maybe early plus or minus 5 years on the GFC, we were somewhere in between 3 and 4%. So the point being, the levels that we're at today are pretty low relative to history. So from some context there, we are on average spending a lot less in terms of our overall spending patterns here. And if you even expand that out to include food and energy, you're seeing that same sort of backdrop, but it's been more consistent, right? If you go all the way back to the 1980s, for example, that wallet share of food and energy was basically about 23%. That's a big chunk. It's drifted down consistently, basically to the late 2010s, early 2020s, and sits at about 12%. So it's almost come down by 50%, so to speak. And I think that provides some context. But when you think about those kind of numbers, the thing that starts to become a little bit confusing is you're looking at it in aggregate, and in aggregate can give us a little bit of a misleading backdrop. So what I was able to do here is go into the Bureau of Labor Statistics, and they put out this consumer expenditure survey, and they actually break out some of those spending patterns relative to the income brackets here. And so they break them out into these 20% shifts. And what's interesting when you look at this first composite, so to speak, if you really look at the big blue lines here, that's the bulk of the consumer spending that's going on for essentials. And it's largely being driven by shelter. So as a percentage of our wallet share, we're basically spending the bulk of our money on shelter. And you can see the lowest cohort, the lowest 20% income earners are spending almost 50% of their income on shelter. So think of things like rent, basically as that descriptor there. But it starts to drop markedly. And I think the big difference here, you get out to the middle 20s and up, you're not really seeing a big difference in terms of those spending patterns. So the big ones that are being impacted, obviously the lowest cohort, maybe a little bit to the lesser extent, that 20 to 40 segment, 20% to 40% decile. But the point being, it really all falls onto that lowest cohort. But when we start to think about that lowest cohort and what's maybe potentially helping them, and this is where I think it gets a little bit interesting, let's look at what they have available to actually defend themselves in terms of higher prices. And in this case, I'm just showing you the change in the assets or their liquid assets. So think about that as basically being cash and cash surrogates since the start of the pandemic, because over the pandemic, what do we see? Well, you had unemployment checks going out, you had stimulus checks going out, plenty of cushioning that was sent out and basically fall into that sort of the checking savings deposit portion of the bank accounts. And again, it's broken out by those segments. And the key here is this red line. And you can see you didn't really get a huge shift in terms of those gains for that bottom 20%, but you can see a lot of that ended up accruing to the upper quartiles, if you will. And so what you're looking at here, we're just trying to get a sense as to how much the large size of those changes. And in some cases, it was 1 to 2-fold the actual increase that a lot of these cohorts picked up in terms of that short-term cash deposits. But even more importantly, if you look to the far right here, this is the actual number that we're talking about. So for example, you can see here the top 80 to 99 percentile didn't see quite the level of growth, but the absolute number in terms of their financial liquid assets sits at almost $3 trillion. So even though they're not seeing growth from a percentage terms, it's still a very large number. But the point here, again, you can see that bottom 20 percentile not really seeing huge gains. And in aggregate, they're sitting with roughly about $111 billion. So again, a lot of that income is accrued to the upper brackets. And we're seeing from that first chart I showed, the ones that need the money the most is that lowest income level. And yes, those guys have the highest marginal propensity to consume. So the concern is, can they keep it up? Well, if we sort of flip to the Atlanta Fed data that comes out, and they're breaking out wage gains based on those quartiles as well, you can see here, and this is a little bit of an anomaly because historically speaking, you don't really see those bottom quartile wage gains really manifesting. We're starting to see that more recently. You can see coming out of the pandemic, that bottom quartile wage growth really started to accelerate. We're accelerating up closer to 7%. And to put that into some context, if you assume that inflation, that last CPI print came out at 8.6% year over year, are the bottom quartiles keeping up with that? Not really, but it's not that far off either. And you can see the other quartiles not keeping up, but they also have a greater level of savings to dip into. So the point here, yes, we're not seeing that big savings accrue into the bottom quartiles, if you will, but they're the ones that are seeing the largest wage gains. That's sort of giving you a little bit of an offset. And the other thing to think about too, not everybody's inflation basket is going to be perfectly aligned with the CPI. One of the examples I'll throw out there, last month we saw airline tickets up almost 13% on a year-on-year basis. If that lowest quartile rung of cohorts didn't fly anywhere, then that CPI basket really wasn't reflective of them. And you could argue maybe their CPI was actually even lower. So maybe they are keeping up with regard to the inflation backdrop with those wages. Point being, maybe we're overestimating the impacts here in terms of how much savings is left over to support the consumer. There's a lot of moving parts here. And even if we do assume sort of that worst case scenario that the lowest rung might be overstretched, might really have some difficult times going forward, maybe they will certainly have to shift their consumption. And let's not kid ourselves. All of us are probably at some point going to shift some of our spending. Maybe we dial it back just a bit because of a lot of the headlines that we're seeing and the uncertainty. But the point being here, what you're simply looking at, this is the percent of share by income percentile for select expenditures. And I tried to think of things that were really on the discretionary side, because if you're going to start to batten down the hatches and really shift some of your saving, it's going to come out of the discretionary buckets. And you can see here the lowest rung across the board, it's basically accounting for less than 10% of each one of these selected expenditures. So let's look at the far right, entertainment. If we started to see that lowest 20% quartile really pulling back on their consumption, it's really only worth 8% of total money spent in aggregate for entertainment. So is that enough to derail the economy? And Joe, again, as you highlighted, 70% of the U.S. growth backdrop is consumption driven. If we get a little bit of a slowdown at an 8% quartile, is that enough to really drive us into a recession? Maybe we're overestimating some of the backdrop here in terms of the potential impacts. And as a result, maybe things are a little bit better. but it's not just all about savings, right? Don't forget, we also have our wages that have been going up, and the wage growth has really been helping out that lowest 20% income bracket.
It gets back to that discussion I was saying that in that commentary about stock versus flow, right? That the consumer has a lot more stock of savings than people realize. As much as that savings rate maybe is coming down and that gets all the headlines on Twitter, they still have a decent stock of savings that can take the hit. And so it may be better off than what people think. We'll move on to you, Garrett, as well, and get back to kind of the core topic of inflation again. And some of the green shoots, as I said, that we're seeing that show maybe signs of cooling. So let's talk a bit about wages, which Jack already mentioned, inventory levels, supply chain. Where are we seeing signs of this kind of potential cooling of inflation in kind of key areas?
Yeah, so I think there kind of was a narrative that emerged out of the May CPI report that we took a really big hit and a negative hit to the inflation outlook. But when you really do start to dig under the surface, I mean, I think a lot of people expected something of a hot print, mainly because of food and energy prices. But underneath the surface, you're still seeing signs of kind of that more nuanced view that is improving day by day. And nonetheless, the Fed's not taking that nuanced view right now, but I think the nuance is going to become more and more important as we move through the summer months into the back half of the year. So if we jump into the first signs here, the first one I think is really, as you mentioned, the wage front and related to the labor market. And so obviously wages have moved dramatically higher here, as we've seen, most acutely in the lower wage baskets here. But what we're seeing on an aggregate basis. So think about this not just in terms of the wages that are being paid, but the aggregate earnings for the U.S. consumer. So multiply the number of people employed in the economy by the average hours worked by the average hourly earnings. And that's how you arrive at essentially the aggregate income for the U.S. consumer. And you can see we're kind of looking at this on a more high frequency basis. So we've taken the 3-month rate of change and annualized that. And what you'll notice is that we've seen a really marked rollover over the last 7 or 8 months here. So coming off some very elevated levels around almost 15% aggregate earnings growth and rolling down underneath 10 to something a little bit more sustainable, getting back close to that pre-COVID average. And we're settling in at levels above that pre-crisis trend. So that means still very strong consumption power and still strong consumer growth. But the bottom line is you are seeing some of that momentum slow, and that's encouraging to help at least bring that demand side of the equation back and more in line with what we still see is somewhat constrained supply side in the economy. But if we jump ahead, we're also starting to see a little bit of that tightness in the labor market start to loosen up. And that obviously is one of the key focuses for the Fed. That obviously translates to some of the slowing momentum within wages. But, we're not seeing the labor market really crack that suggests any sort of recession is imminent here. But we're seeing some softening, which is encouraging and suggests that maybe that unemployment rate is starting to bottom out. And that would certainly suggest that a labor market that's much more sustainable and not overly hot here in the intermediate run here. So this next slide you're looking at, the light blue line just tracking those weekly jobless claims that you can see drifting higher, and the monthly or the weekly changes is the bars moving vertical. And you can see we're starting to have a little bit more surprises to the upside here that shows a little bit of that slack starting to emerge. But it's not just the labor side of the economy. We've heard a lot of comments, not just from the hard data from the government, but from a lot of these big employers, especially in the retail space. Think Amazon, Walmart, the biggest employers in the economy, saying that they've overstaffed, they need to rationalize. That means more slack coming into the labor market, and that's exactly what the Fed wants to see. But on the good side of the equation, we're seeing a similar dynamic play out, and a lot of those long-held supply shortages have quickly evolved into supply gluts. So again, going back to a lot of those same retailers with their reports for Q1, we heard a lot of talk about excess inventory builds, something on the order of 30 to 40% inventory growth, well in excess of what sales growth is. And if you look at the government reported data here for broad retail inventories across the entire economy, and we've stripped out the auto sector, we're all very well familiar with the shortages that are still persistent within that sector, and it distorts the data a little bit. You'll probably continue to see strong production there moving forward, which again is helpful for growth. But on the other side of the durable goods equation, you can see that inventories are now 16% above that pre-crisis trend. What do you do when you have too much inventory? You cut prices to try to unload that costly inventory. And that's a very, very powerful disinflationary and even outright deflationary force for consumer durable goods, which were a key portion of a lot of the inflation surge we've seen over the last 18 to 24 months here. So more signs of not just in the labor markets, but in good supply. We've moved far, the pendulum's kind of swung from far too tight to far too abundant in terms of that supply side. And if we start to think about the supply chain coming down moving forward, we're also continuing to see some really market improvement on that front. We track a lot of the survey data coming out from the regional Fed manufacturing surveys. So we put this into kind of an aggregate index to track what are these business leaders saying in terms of the prices they're paying for inputs, what are they seeing in terms of the delivery times. And obviously, as you can see, both these series moving aggressively higher. We've Z-scored them to kind of give you some historical context. They've moved to historical extremes. No surprise, as we all know about those supply chain constraints. But we've seen them really roll over significantly. Last week, we got even more recent data from Empire State, from the Philly Fed. Today, we even got Kansas City, all confirming really a significant improvement in those delivery times. So supply chain constraints are rapidly easing. So we already have too much goods, and now we're seeing that the supply of those incoming goods moving down the line is going to likely improve even further in the months ahead. All signs for disinflation and lower rates of inflation. And the last one to keep in mind is when you think about a consumer-driven economy like the U.S., well, we produce a lot of goods, but obviously we need to import a whole lot of goods. And so what prices we're paying on those inputs can have a pretty powerful impact in terms of inflation here in the U.S. And something to consider is the strength of the U.S. dollar has actually been very helpful for keeping inflation somewhat in check from that import perspective. When you really think about it, a lot of kind of econometric models suggest about maybe 20 to 30 basis points of a reduction in CPI for every 10% that the dollar appreciates. Well, if you take that back to, the last year, we've seen the dollar really surge significantly higher, about 13% since last June, almost 7-8% just this year alone. And those effects are really coming through. And you can see that in the import price indices that we have on this last slide here. We're looking at it on a year-over-year basis in the purple, but again, to give you a little better look of kind of the more recent trends, that 3-month annualized number has really plummeted over the last couple prints here from about 5% to inside of 1%. So you can see how dramatically things are shifting on a lot of these fronts that have been key drivers of the inflation story over the last 18 months. They're starting to improve dramatically. The more that we see that play out in the month ahead, the less that the Fed can really ignore that nuance, because it's really going to have a meaningful impact on inflation prints. And again, going back to what's priced in, that could suggest that the Fed may have the ability to step back a little bit from what's really a very aggressive rate hike that's priced into markets currently.
That's great, Garrett. If you bring it back to kind of real life examples, we've written about this. Jack, you did a few weeks ago. That inventory build is real. You're seeing companies like Target and Walmart and other big retailers talk about big inventory levels that are on the books. So it's definitely happening. It's a real thing, and could be a sign of things to come. So we're going to shift for a second here over to housing. And Garrett's going to take this one to start. And then Jack will make some comments here as well. But housing is obviously, as I said, kind of the bedrock of the economy in a lot of ways. It's another area where some prognosticators are calling for a 2008-like effect, where a bubble may be bursting, similar to what happened then. Mortgage rates are in the 6s, which isn't terrible from a historical perspective. And we are seeing more signs, though, of some price drops. But buyer health and coming supply could alleviate some of that pressure. So, Garrett, can you talk about where supply is now, the health of today's buyer, and what's to come based on kind of some long-term secular trends, and then talk about kind of that pending supply that we could see in the system kind of coming to market as well?
Yeah, there's a lot to unpack there, but I think there's a couple key things to keep in mind, and you kind of alluded to it. As much or as little as we try, we can't really shake the scars, those deep scars from 2008. And so that really is very deeply ingrained in consumers' mindsets, investors, and certainly in home builders' mindsets. And that has really important implications for the housing market and for the broader economy as well, based on the fact that it is really the bedrock for the U.S. economy. But, I think when we hear all these comments that, we're in another housing bubble, it totally misses the underlying dynamics that are at play here. And if we pull up the next slide, you can really see that it's not a story of really, unreasonable price surges. the reason why we've seen prices moving so aggressively higher is simply because we have structurally underinvested in housing for a decade now. And so we simply don't have enough housing units to supply what is increasingly higher demand due to demographics and, through the COVID crisis, some shifting consumer or home buyer preferences as a result of, COVID issues. So this first chart, I think, does a great job of outlining this. If you just take a look at months of supply of homes on the market on the left axis, and we've inverted that. So the higher these dots go, that means the fewer or the less available supply on the market. And then on the x-axis, you can see the Case-Shiller National Index on a month-over-month basis. And it's a pretty strong relationship. The lower your supply, the higher your price appreciation. And this example, through the COVID period has been no outlier, really. It's really followed very closely in line with that trend. So it's a story of lack of supply into robust demand, and that's why you've seen prices surge. It's not a really unjustified bubble. But I think the other thing to keep in mind, and why this really isn't a 2008 type scenario, on the next slide, you can see what the origination in terms of mortgages looks like. This is nothing like 2008 here. Bottom line is if you start to break down mortgage origination by credit buckets, the years leading up to the financial crisis and the housing bubble was dominated by a lot of low quality, low FICO score mortgages. So we were giving out mortgages to people that couldn't afford them, very lenient standards if they were even existent at that point. The shift that you've seen in the years since is really dramatic. You see hardly any origination at the lower FICO score bands. It's entirely dominated by essentially 760 scores plus. And so the people that have access to mortgages, they've been very well qualified here, and that risk of kind of the dynamics playing out in 2008 are much lower. The other thing to keep in mind is surging mortgage rates on their own isn't what led to the financial crisis and the housing bubble bursting. It was the fact that a lot of those mortgages were actually adjustable rate in nature. And so when you've seen, all of the origination in the years since really been fixed rate, you don't have that risk where all of a sudden, all of these homeowners can't afford their mortgages, they find themselves underwater, and you see a series of waterfall declines because of all these forced selling. That's simply not the dynamic here. You actually see that rising mortgage rates makes, real home costs for current homeowners actually decline because of those fixed rate mortgages here. So it's a very different dynamic. But if we jump to the next slide, you can see that, yes, mortgage rates have moved higher. Demand has taken a little bit of a hit as a result because of affordability issues, but demand is still going to be robust because of just sheer demographics. I think a lot of people brush to the side the power of demographics in economic cycles, and certainly for the housing market, it matters. The millennial generation is really coming into that peak bulge in terms of the number of millennials entering peak household formation age, peak earnings age, and peak home buying age. And that is a big reason why you've seen so much demand over the last couple of years. And that's likely to continue. And think about it, millennial generation is the largest cohort in the US since the baby boomers. It is very, very large and very, very powerful. So that demand is still there. But the last thing to keep in mind, and why growth might not slow so dramatically because of housing softening at the margin, is because it's not just the home prices that filters its way into growth. On this next slide, you'll see essentially there's still a very considerable pipeline of housing growth that is going to feed into economic growth. And the way to think about that is what really feeds economic growth is the investment, the residential fixed investment, the construction spending to build these homes. And when you look at what's happened through the pandemic, well, the housing market has certainly not been immune to supply chain constraints, labor supply issues. And what this chart shows very, very well, the purple line is simply your completions of new homes. That has lagged very dramatically from what you see in the gray line, which is the number of homes currently under construction, as well as the light blue line, which is kind of a little further down the pipeline in terms of authorized permits that haven't yet started. So you can think about it this way: as those supply chain, labor supply issues start to alleviate, you are going to see a significant uptick in the number of completions, and the homes that are currently under construction, you're going to continue to see construction spending into those homes to complete them. That means not only will you continue to see growth coming from the housing sector, but you'll also start to see more supply coming into the housing sector. And as we just talked about, there's still plenty of demand there. So yes, we've seen some softening. That's ultimately what the Fed wants to see as one of the very powerful pass-through mechanisms of monetary policy, but it's not a 2008 type scenario by any means for a number of reasons, as you can see from the prior charts here.
Important point there, Garrett. The Fed wants to see it soften a little bit. That's the key. Going to you, Jack, and staying on housing, but it kind of relating it back to inflation. Overall rents and kind of owner's equivalent rent has become a bigger part of CPI overall and bigger part of the headlines. Can you talk about what we're seeing here and some of the signs that can indicate things are cooling as well? And what about kind of the wage backdrop as it relates to that as well? And you mentioned that earlier with the consumer. Can you hit on that?
Yeah, we'll jump right into this first chart here. When you start to think about the housing market, one of the biggest concerns that we hear from clients in sort of the media backdrop is, rising rents, rising home prices. That's going to ultimately continue to push inflation higher. Those can be stickier for a longer time in some cases on the rent side. So maybe that on the backside of this, when we have peak inflation and we start to look for the deceleration in the coming quarters, maybe inflation doesn't come down at the pace that maybe some of Fed officials would be hoping for. A couple of things I wanted to point out, though. In this first chart here, we're just looking at the total monthly contribution of housing to core CPI. And what's interesting, I got the dotted red line in here to show you what the average was basically pre-COVID. But when you get into the COVID crisis, you can see we basically have this like nice little shallow swale, so to speak. Well, all of a sudden now, as we sort of get to the back half of last year and into this year, we're certainly seeing both the rents and owner's equivalent rents starting to pick up aggressively. What's interesting, that's basically making up for the shortfalls here. So while, more recently, a lot of the contribution from the pickup in rents is starting to hurt CPI from a core perspective, we're really just making up for lost time, right? You had all these people that were basically leaving the cities and moving out to the suburbs. Basically, a lot of the landlords are having to cut rental prices to try to get people to come back in. And that's where you sort of see this swell. Now everybody's sort of migrating back, if you will, and we're seeing just the opposite. So we're just seeing some catch up here. And if you actually extrapolated this out in terms of a trend, you're really back to basically the pre-COVID trend level. So a lot of catching up to do, so to speak. And I think that's being a little bit maybe misunderstood or misappreciated, if you will, underappreciated, simply that catch-up component. But one other thing to think about when we start to look at owner's equivalent rent and rental of primary residences, it's the constitution of both the metrics that we look at in terms of inflation, right? The one that matters the most is going to be PCE for the Fed. That's the one that the Fed tends to focus on more times. And we hear a lot more about CPI in the press. I wanted to highlight a few differences, first of all, that we might be seeing with regard to both of those, right? CPI often is going to be a survey-based backdrop, right? They're going to go out and ask people, what are you spending your money on? And that's how they come up with the weights within that basket. PCE is a little bit different, where they're actually focusing on real sales. So they're looking at what consumers are really doing, not what they say they're doing. And there's always been a mismatch with that backdrop. But the key difference is basically the constituents within there, right? We know there's notable weighting differences between CPI and PCE. Most notably, it's really the healthcare and housing components. The housing component's the big one. Why? Core CPI has a 41% allocation to housing prices within that, or housing-related components related to it. Core PCE, the one the Fed focuses more on, is only 17%. So you're going to see some pretty big differences in these prints going forward. And what's interesting, if you look at the historical divergence between CPI and PCE, it's been running at about 33, 34 basis points, CPI running above PCE. That's obviously going to be changing, and we're seeing that already. Most recent prints, we're running north of 150 basis points, and that's because of these components that we're talking about. So bear in mind, there's a huge difference in terms of those constituent weightings. Housing gets a much bigger weighting in CPI. The Fed does tend to focus more on PCE. But regardless, we are seeing signs of slowing. And this chart here is taken from the Redfin data. And you can see percentage of active listings that are actually seeing price cuts. So houses going on the market for sale. And what are we seeing more recently? Well, we're seeing an uptick in the number of houses that actually have to cut that asking price to try to lure those buyers back in. So again, some signs that we're seeing softening in terms of that market for housing prices. It's starting to come down. If we shift over to the rental backdrop, what we're looking at rental prices, we're seeing sort of the same thing. This was actually Boston right here. I had in the top left. The rental prices there rolling over. You can see Miami rental prices rolling over. Los Angeles, question mark, maybe we're at that peak. New York City still aggressively pushing higher. But the point being, we're again seeing signs scattered around the country that these rental prices are starting to roll over as well. And if you look at other places around the marketplace, and I tried to pick some of the major markets for this chart, San Diego, Los Angeles, Salt Lake, they're all starting to roll over. So we're certainly seeing signs of softening both in the rental apartment complex as well as the home backdrop. And this filters back into the last chart here, where when we start to think about, well, what really drives these prices? It really comes down to worker income, right? Landlords know if people are getting paid more, they can charge you more. And that's basically what we're trying to overlay on this last chart here. Just looking at the different metrics of wage gain. So you can see the dark blue, the median wage gain coming from the the Atlanta Fed survey. And then the purple line, that's the employment cost index, another all-in metric of worker income, if you will. And they all move in tandem with basically however you want to look at imputed rent costs, that sort of thing. But the bottom line, all of these shelter costs tend to be highly correlated with worker income. It is back to what Garrett was talking about. We're seeing signs of the labor market starting to soften up. We're seeing signs that wages in some particular sectors are starting to aggressively roll over. So the point here, it will take some time for this to work its way through into the CPI and PCE numbers, but we certainly are seeing signs that there should be a continued drop in housing prices, in rental prices, and as a result, it might take a little longer, but that's ultimately going to feed through into the inflation data that we're focusing on and basically start to drag that lower.
Yeah, the big thing that I think the market doesn't appreciate that's simmering underneath the surface, Jack, is that difference between CPI and PCE. The Fed follows PCE, and housing is less than half of a component in PCE, and the Fed views it as more reliable. And I know gas prices are high, and everyone's sensitive to that, and housing prices have gone up. But that's an interesting data point that we need to continue to watch. So, Garrett, we're going to transition over to you again and talk a little bit about recession risk, which is now cropping up again, just with the fear that the Fed may over-tighten. The odds of recession have noticeably increased, especially over the last month or so. Can you talk about what's been priced into kind of the equity markets and then what's been priced into other asset classes overall? I think you have some interesting charts on that.
Yeah, absolutely. And we've kind of talked about this for, a month, maybe a little bit longer, that we expected this kind of inflation fear to morph into that growth scare. And obviously that's kind of accelerated into full-blown recession fears. But it kind of makes sense. And, especially with that CPI printed for May, with the apparent shift to, headline inflation and gas prices that the Fed can't really control, well, it's really gotten a lot of these fears into overdrive. So if we jump to the first slide here, we kind of went through a simple exercise here, and by no means is it totally, bulletproof, but I think it gives you a little bit of an interesting context for how markets actually price in recession odds. And the basic way we did this is just taking a look at peak to trough drawdowns in equities in the S&P 500 and comparing that to prior recessions. And we've kind of defined mild versus your kind of run-of-the-mill average recession versus deep recession based off the level of earnings contraction in those environments here. And the bottom line is, with a 25% drawdown that we've already seen, the market's already priced in fully that mild recession scenario and done a lot of the heavy lifting to price in even your run-of-the-mill average recession. That sees a pretty good hit to earnings for the corporates here. So we've priced in quite a bit of damage at this point, and it remains to be seen how things play out. But I think what's interesting is when you start to look across asset classes, you're starting to get some diverging viewpoints. So if we expand this exercise and look not just at equities, but start to look at, say, industrial metals, and we can look at equities, or credit, both IG and high yield, and look at the treasury space, you're starting to see some very different stories. So in this case, we see the S&P 500, and we've looked at the average recession on this slide. You can see industrial metals maybe raising some alarm bells, but it's a little bit distorted by the surge that we saw based off on the wake of the Russian-Ukraine invasion. But when you start to look across the rest of the asset classes here, really not seeing concerning signs. IG credit, high yield credit, spreads have widened, but on a historical basis, we've pretty much just gotten back to average, and certainly haven't widened out to recessionary levels, even remotely close. So when you start to think about specifically high yield as kind of the tip of the spear, the canary in the coal mine, certainly isn't suggesting any fundamental stresses in the economy here. And treasuries as well, you've seen a bid back in, but it's certainly not the type of bid you would expect in a recessionary environment. Now, maybe that's simply because the pressures are moving the opposite direction to fight inflation, and we just haven't given it enough time for that growth scare to really kick in. But the bottom line is, credit, I think, is really telling you some very strong stories. Their fundamentals are very robust. And even in a recessionary environment, it's hard to see a whole lot of damage there and a real pickup in a default cycle, just because they're staying robust and their spreads are telling you that. But the other thing to keep in mind here is, I think what's fueling that fire is what you're seeing in the real data. So, maybe equities are being a little bit of more of an emotional barometer than what credit's telling you, but a lot of the data is really fueling that fire. And when you think about what's driving the economic surprise indices, so remember, that's comparing incoming data prints to expectations. Well, you can see the first bar here on the left-hand side. That's what we're seeing in terms of current surprise indices. And obviously the data has been, somewhat disappointing and is coming in at below expectations. But if you break it down to see what's driving that, again, a lot of this is exactly what the Fed wants to see. The biggest driver is the biggest pass-through in terms of the transmission mechanism of monetary policy. It's housing. So you're seeing the softness there. You're seeing some modest softness in labor markets. Again, an encouraging sign the Fed wants to see. Retail and wholesale, we talked about the excess inventories. That's obviously having a role, as is the rotation away from goods back towards services. And then surveys, well, sentiment's obviously taken a hit, and business leaders are certainly not immune to the effect of lower prices. But think about what looks strong. The industrial sector is still holding up, and the household sector. Those balance sheets in the household and corporate sector are very, very robust. So that's still holding this economy up, and it can still be a very powerful driver to stave off recession. But even if, say, we're wrong and we roll into a recession, think about the type of environment that's going to be. Is it going to be a deep, protracted one, or is it going to be more of kind of a mild recession? And if that's what you get, we've probably priced that in. And if we don't get a recession, we've probably overshot materially here. And that really suggests that as that doesn't pan out, we could have some really material upside for equity prices as well as credit prices.
Great takeaway there is the difference between equities and fixed income, right? Some would argue the fixed income markets are a little smarter than the equity markets, and who knows, but interesting sign there. I'm going to move to you, Jack, and talk about some of the interesting trends that you're seeing overall in the markets, and that could be indicators, I guess, for maybe the inflation theme kind of rolling over and maybe the market bottoming. So we'll go to you next.
Yeah, and I pulled up a couple of indicators that we're paying attention to. As Garrett mentioned, credit seems to be very well behaved. There's certainly plenty of tells that are out in the marketplace that are indicating that, inflation and rates are probably close to that peak backdrop. So I pulled a couple here that I think are very interesting because it's telling us basically that same story. This first chart that we're referencing here, and these are relative price returns. So think of it as an upward sloping line. This EQRR ETF, which is basically going to be the equities for rising rates ETF, it's relative to the S&P 500. So this ETF is outperforming the broad market. And if we get a line going south, heading down, the broad market is outperforming the respective ETF. And you can see these are basically what we would consider to be inflation proxies, right? The three that we have on the line here, you're looking at some sort of an oil consideration, some mining and metals that are buried within there, as well as the financials and banks, all going to be a net beneficiary of higher inflation and higher rates. And you can see for much of this year, it's been a straight uptrend, right? That's been the inflation trade. But what are we seeing more recently? In all of these cases here, we're seeing a rolling over, meaning the broad market more recently has started to outperform those inflation proxies. And the one I would also highlight in the light blue here, it's energy versus healthcare. Historically speaking, that's a pretty good timing mechanism to indicate when things are starting to roll over. And to pull us into the next chart here, keeping this in mind, because that's what you're looking at here, it's the Russell 3000 energy subcomponent relative to the Russell 3000 healthcare. And I've basically just put underneath that CPI. And again, there's certainly some instances of false starts here, but the point being, when you got a peak in that relationship between energy and healthcare sectors, it sort of coincides with that peak in CPI. And so that's what these dotted lines are trying to show you. When did you see that peak, if you will, in CPI? It also tends to match a short-term peak in some of these relationships between energy and healthcare. So the fact that we're starting to roll over right now in that relationship between energy and healthcare, starting to throw up some signs that maybe now not only the bond market, but the equity market's starting to tell us that, hey, maybe it's time to start looking at rates sort of bottoming out in here. Inflation's bottoming out. And as a result, we might see peak inflation and also peak rates at current levels. So one market tell that we're paying attention to, not just looking at rates, but trying to confirm it in the other portions of the marketplace. One other sign that we also note when we've gone through these major drawdowns, these major corrections in equities, what tends to happen, well, we tend to see tech outperforming to the upside. And what's interesting, if you go back and look at the dot-com pop, for example, and again, looking at relative price performance here, you're just looking at the NASDAQ 100 relative to the broad market or the S&P 500. And you can see here, NASDAQ started to bottom relative to the S&P and basically we started to straight shot up. If we draw that same parallels time frame down, S&P sort of still chopped a lot of wood, but finally started to break out. Same thing when you go back to the global financial crisis here. NASDAQ sort of chopped around and finally started to break out relative to the S&P. Look down here, it took a little while for the S&P to finally get going, but once you got that confirmation a couple months later, S&P bottom and started to push higher. Where are we today? S&P can, certainly is treading some water here. But what I think is interesting, that relationship, that NASDAQ relative to the broad market, what are we seeing? Well, you've got a bunch of higher lows, right? All of a sudden, we got the bottom here. We got a little bit of a downtick, but certainly didn't match this low. Is this the beginning of starting to see a reversal in that relationship? And historically speaking, when you start to see NASDAQ consistently outperforming the broad market, in past occurrences, that's been a leading indicator that we're pretty close to a bottom. So we put a lot of these sort of market mosaics together, and it tells us some interesting stories. You can also layer a few other things on there, right? Treasuries went all the way up to 350 and recouped a lot of that off of basically the worst CPI print that we've had in a long time. You're starting to see growth get a little bit better relative to value. We walked through a couple of those individual ETFs that are more inflation and rate sensitive. There's certainly plenty of tells out there that are starting to roll over. It remains to be seen if that's it. But those are some of the things that we're paying attention to tell us, hey, the worst might be behind us. Time to start maybe looking to add to risk as opposed to running away from it.
That's great, Jack. Thank you. There is a good question in here that relates back to inflation that I think is important. I think it's a question that comes up a lot from our clients and I think from the general public. And I'll direct it at you, Garrett, which is the fact is that energy is way up, gas prices are way up. Doesn't that have a negative feedback loop or knock-on effects for all the other kinds of inflation as it reverberates through the system? Things like harvesting food, transportation costs, things like that, in terms of that oil price again and that gas price reverberating through the system. Can you comment on that?
Yeah, it's a good question. And obviously, as an input to so many other things, it can obviously place some upside pressures. But, I think what's kind of interesting is think about the other side of that. If you do see, especially at lower incomes, more of that income going to less discretionary spend because of food and energy prices, that starts to weigh a little bit on discretionary spend and starts to weigh on some of your other core expenditures. So it can have kind of conflicting impacts on, yes, it can increase, input good costs, but it can also start to weigh on some of the demand side for those goods as well, and that can help to offset some of that.
If I may add a kind of a quote to that one, the cure for higher prices. That's exactly what you were talking about right there.
Excellent. Yep. A great question and a great answer. Thank you, guys. So let's finish maybe going to each of you with kind of second half risks maybe and some opportunities. We'll give you kind of the final thought here with a few minutes left. Garrett, maybe we'll start with you and then end with Jack.
Yeah, so I think, the biggest second half risk, it's going to come down to inflation. And at the end of the day, the data is in the driver's seat. We walked through a lot of the encouraging signs and the nuance and the green shoots. But I think the big risk is if these prints still remain a little bit stickier, then that's going to suggest that the Fed needs to be, more aggressive. If they improve better, then they can step back a little bit. But that's going to continue to be the biggest question mark moving forward, is whether or not we see those decelerations, especially on the goods front, to offset what we're seeing on services. And if we don't, then that dot plot might be fairly accurate in terms of what we actually see by year end.
That has been the primary issue. It's been stickier than I think we all thought, and so that continues to be the big headline. Jack, any comments from you?
Yeah, and this is sort of a tangent to what Garrett just talked about. Let's just pay attention to energy prices here, right? A persistent and elevated oil price obviously is going to have some adverse impacts. So keeping an eye on where that ends up. And the one thing I would also highlight, though, the commodity complex has gotten what I would call financialized, right? A lot of us on the retail side now can actively trade these things. And I think that's sort of changed the backdrop, right? So when you think about oil prices back in the old days, before it was sort of financialized, it would just trade on supply and demand, straightforward. But now you can see, because it's financialized, hedge funds and players can come in and use it as a growth proxy, for example. So, if I'm expecting growth to accelerate, it's probably going to require more oil consumption. I'll go long oil, that sort of thing. That's what I mean by financialized. And so when you think about how that's played into oil prices, there's probably a tendency for commodities to overshoot because of that. And that could be one of the things we could see in the near term with oil. You've got a lot of the trend chasers in there. You've got, the financialization, if you will. We can see that certainly overshoot to the upside because of this. And when that starts to unwind, we can certainly see it move aggressively to the downside here. So I think certainly you'll see some increased volatility because of that. But the point, it all comes down to inflation, and obviously the headline sticker shock is going to come from oil and gasoline prices.
That's great. And I think the point of the call today, though, is that there's a lot of signs that we could see better days ahead and better months ahead through the rest of the year. It does seem to come down to inflation and rates, folks, and that's been dominating the headlines, and we need to see alleviation there of some pressures.